So it's working. Right, so yes, very good example. Unfortunately, like I don't have the skill to set this up myself, so I'm just definitely do it. And he's not sharing his secrets. But the basic idea is clear here. Right, so there are definitely markets where arbitrage is feasible, right? Because people are not behaving rationally. Like sports betting is something that's highly emotional, right? People are betting on their favorite teams even if they're going to lose. Which, by the way, is something you shouldn't do. You should always bet on your opponent. Because when your favorite team wins, you're happy anyways, and if your favorite team loses, you at least win some money, right? So you compensate your losses. But let's come back maybe to financial markets. Did you believe this, that the financial markets, like the stock market, is free of arbitrage? Because that would be kind of the requirement for using this, right? If you don't believe in this, that would be a bad thing.
Probably with the lower profit or the lower dividend, companies may have, you can do arbitrage free markets. But they will, if there is no risk, the profit probably won't be that high.
Yeah, so that might be true, so that the more risky strategies give you more profits. But remember, the risky strategies are not part of our definition here. So the question is, or let's talk turn the other way around. Do you believe that financial instruments have the same price everywhere, like Daimler shares? Or are you able to find price differences between, say, Frankfurt and Berlin?
I can't imagine how they can be different.
I mean, there are different people trading there, right? There are two people in Berlin meeting, and they agree on a price. And at the same time, there are two other people meeting in Frankfurt, and they agree on a price. Right?
But shouldn't shouldn't it be corrected, like, overall? In like,
Yeah, so that is now a point that goes in this direction. So do you believe that there are people who correct this, right?
I think it doesn't make sense that people, like the market maker, corrects it right away.
Mm-hmm.
Because then it's not gonna be beneficial for them, like the people who control it, because they can like sell in a price that they are not willing to sell
Mm-hmm.
if they wanna like correct the prices. So I think it doesn't make sense for me.
Mm-hmm.
I think like the price differences will always be there.
So you believe that these will persist? All right, so we already have two opposing opinions here.
Yeah.
Which I think you can actually find arguments for both directions. You mentioned the word market maker. We haven't defined this, so maybe let me just explain this for everyone. So market maker is someone who's usually paid to facilitate trading. Right. So these are people who do nothing else than basically, if there is no buyer for something, they will buy instead, and they will hold it on their books and sell it on later to someone who's willing to buy it later. Right. So they're kind of trying to provide liquidity in the market. So they're making the market liquid. Sometimes they're kind of paid by the corporations, like Daimler pays the market maker to make the market for their shares. And banks do that, like Deutsche Bank has derivatives and certificates that are traded, so they are market making for their own products. So they always be the counterpart in this trade. Yeah. Do you believe that there are other investors who do these kind of things? Well, the market makers, basically their bread and butter to look at prices and
central banks, but they kind of don't buy stocks, they buy
yeah, so central banks are buying securities, mostly bonds. But that is, first of all, it's a highly controversial thing. So the German central bank opposes this heavily. And they're holding this actually for long term. So it's not like they're buying and selling immediately. Right? So it's a slightly different strategy that they're following. Do you believe that these people, like arbitrageurs, exist that want to do these strategies? Well, they seem to be attractive, right? Yeah.
I think no, because from my knowledge, arbitrage comes from a time when you had this time difference between markets. Nowadays, you have almost no time difference because every information is changed concurrently.
Yeah, that's a very good point. So arbitrage is, of course, more feasible or easier feasible if there's less transparency. Like in the old days when we didn't have computers, if you wanted to know that there was a stock crash in London, how did the information get to you, right? So maybe there was a telegram that was going to send, or in the times when we didn't have that, someone was writing a letter, sending it by ship, and 2 days later in Amsterdam the ship arrived and people said, okay, 2 days ago there was a stock crash in London, right? So there's, in the past you have these time delays, right? Why, like cities like Hamburg and Amsterdam, continental Europe were so important because that's where not only the goods arrive but also the information arrives from other places. Yeah, nowadays you just look on the computer screen, right, and you immediately see these price differences. Yeah, but let me challenge that a little bit, because I believe it's kind of a chicken and egg problem. So if these arbitrage opportunities exist, as you argued, but there are no people who utilize it, then they will persist, right? Now, if these do exist, shouldn't there be investors who jump on them to make profits? Well, if they make profits, yes. But then when they utilize the strategy, the arbitrage opportunity should disappear, meaning that they can't make any profit anymore. So again, they're basically out of business, right? So they're kind of required to correct the prices. But when prices are correct, they're not profitable, so they're running out of business. Right? So that's a little bit the ambivalence of this. So if you believe that prices are different, there must be people who can utilize this, and I can assure you there are actually people who do this. It actually runs down to a speed problem at the end, so it's a very good point that you brought up. But the problem is then when these things disappear, it becomes unprofitable to do, so the investors who are required to do the correction here are going out of the market. So does someone actually know, coming to the speed point, how these professional traders that do exist actually make this or do this?
Do they arbitrage?
Yes. Probably you might have heard the keywords behind this. So do you think there is an individual sitting on the keyboard and typing in orders when it's about speed? Yeah.
With algorithms. I think BlackRock has this famous supercomputer which finds these golden eggs.
Exactly. So algorithmic trading or computer-based trading is basically the thing that kind of jumps on these strategies. So speed is really important. So just give you a couple of examples. Let's do the London-Frankfurt example. So how do you make sure that the information from London gets to you quickly? Well, actually investment banks paid to put a fiber cable through the channel with the maximum speed connection that only they can use, right? They created their own data connection to increase the speed because the internet was too slow for them. The second thing is they do something that is called co-location. So if you want to have the quickest access to a price in the market, what would minimize your transaction speed? Well, you put your computer directly next to the computer of the exchange, right? So they rent space from the exchange in the basement and put their computers there, right? And then there's an algorithm which is controlled from somewhere else, and they immediately see the prices happening. And when I sit here in Berlin and I want to look up the price in Frankfurt, this computer has already traded 1,000 times before I see the price with my slow internet connection. Right?
Yeah.
Right? So there are indeed investors who are specialized on this, and if it happens in the short run, they immediately jump onto it. Such that if we as usual people look at this, and most of the time the price that we see are delayed by 15 minutes anyways, right? We don't see real-time data usually, because that you would have to pay for that. The prices that we see are virtually free of arbitrage. Right? And that would be my selling point here, actually, to say that, yes, they do exist, these opportunities, but there are some people who specialized in this, but they require infrastructure, they require speed and market access that average people like us do not have. And they can use arbitrage, they can do arbitrage, but we don't, because prices are already kind of corrected after these algorithms kind of traded all the opportunities away.
So they will use the time delay, right? So
Yes.
people who have a better access to the market
Exactly.
will be like they will be doing it.
Exactly. So you mentioned BlackRock, which is a big asset manager. I know numbers from Goldman Sachs because I did an internship with them. So they're spending $500 million every year only on computers, only on their infrastructure, right? $500 million, right? And they know exactly in the markets which other bank is faster than them. And I was at the option trading desk in Tokyo, and they immediately, so there was, I think, BNP Paribas at that time, who were faster than them, and they immediately know, okay, we can trade within 2 milliseconds, right? So that's the kind of speed we're talking about. right? Fractions of second, right? So as an average person, you can't react so quickly. You don't have the capabilities to do that. Now, strictly speaking, this is actually violating our assumption of zero cost here because we have to put in money into the infrastructure to actually do it. On the other hand, the mere existence of these investors tells us that it's still profitable after the cost, right? My takeaway would be here that for us as average investors or corporations who do not have these trading desks and these computers, we can fairly assume that financial markets are free of arbitrage. But there are some investors who find these opportunities and trade on them. Right? So that would be my kind of compromise to offer to you, that we can use this pricing principle for kind of corporate transactions. Like corporations don't sell shares every day, right? They do this maybe once a year or every other year or so, right? And they can do that. They can assume fairly that the markets are free of arbitrage. This point is not relevant for them so much.